Equities roll over as Powell reiterates that rate hikes will be front-loaded and short yields explode. China lockdowns intensify, causing commodities to correct. And tech earnings will be the focus this week after Netflix got hammered. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 26th of April, and let's take a look at these markets. So, market action, pretty violent reversal, kind of back end of last week. Again, seeing wild moves in interest rates, as has been the case for like months now. But if I bring up the usual graphic, we can see again just a wall of blue. In terms of what was moving up, and we're talking about Aussie rates, Canadian rates, US rates, everything in the order of magnitude moving up about 2 to 3 standard deviations there. And just, on the back of that reiteration from Powell, pretty much confirming the 50 bip hike coming in May, and, leaving the door open for 50s and even 75s potentially in future meetings, right? So very much continuing with the hawkish rhetoric. Also seeing high yield credit higher in terms of CDS, so credit spreads blowing out a bit there in line with what was going on in rates as yield curves continue, this time flattening again, and that tends to kind of not be great for credit. Stocks obviously reversed sharply lower after a positive start to the week. Now you had large cap tech down pretty heavy. Obviously, Netflix missing their earnings, losing a load of subscribers. They were down 25% on the day, and they're now closer to 40% down from that move. So pretty brutal there, but also seeing, sell-offs in NASDAQ and some of those big tech names as well, kind of leading the way down. The dollar obviously broke higher out of its channel as the kind of risk off set in. And the BOJ doubled down on their yield curve control, so taking dollar yen higher as well, up to around 128. So that's some pretty huge levels, right? 130 is a very, very big level, which if that gets taken out, then all hell could really break loose on that side. But in general, the dollar catching a bid due to liquidity concerns and general risk off kind of tone. Commodities also rolling over, led by silver. That had a horrible week, but China lockdowns really the catalyst there, potential for more demand destruction, and also speculative long positioning that's been around in commodities obviously is still there potentially and needs to get unwound a bit, right? So those are the sort of things that are weighing on commodities and weighing on sentiment in that sector. And then finally, crypto remains softer, but very low vol compared to everything else. Right, so you can see on this bar chart here, crypto is the black one, and those moves are just insignificant relative to the kind of volatility that crypto has. So that's kind of the summary of what's been going on across assets. Yeah. Now, if we drill down a bit and we look at what earnings look like so far, so far earnings have been okay, right? We're looking at about an 80% beat to miss ratio, so that's not bad. But so that's it, and that's kind of in line with previous earnings seasons, right? So this chart at the top from Jefferies kind of shows you typically, we are around a 75% sort of beat for names in the S&P, and that's kind of what we've seen over the first 2 weeks. Now, obviously, we mentioned though, it's about watching the price action and seeing how stocks perform on beats and misses. Obviously, the likes of Netflix getting absolutely punished. And, that made people a bit concerned that some of these other large cap techs that are going to report this week may be fragile as well. Obviously, we've seen Meta last few times they've given earnings. They've had enormous moves to the downside. But, you've had some pretty big swings to the upside as well. Like I remember Amazon was up, 20-odd%, wasn't it? So, this week's going to be interesting. And if these big techs disappoint, then there is some room for some serious moves, and because there's such large weightings in the index, then that's going to potentially move the index as well. Okay. Now, if you look at the chart at the bottom that I'm sharing there, that's BOA's kind of expectations of EPS growth going forward. And, you know, they're looking at, they've got some EPS model and they're looking at earnings having peaked last June and kind of this thing by the end of the year showing negative earnings growth, right? Which, you know, I don't think the whole market is really calling for here. So if that does turn out to be right, then that doesn't really seem to be priced in. A potential earnings recession later in the year doesn't really seem priced in at these levels. Okay, so something to kind of be on the watch out for there. Now, talking a bit more about earnings, obviously the bank earnings are what kicked everything off. And how did the banks kind of trade post earnings? And it wasn't particularly pretty, right? So, you know, you've got JP Morgan, you know, traded down, BOA, and the outlook for the banks, despite higher yields that we've been seeing, the banks just haven't been trading in line with that. And why is that, right? So one potential reason, you know, Morgan Stanley research have put out here that obviously the banks care about what's going on in the housing market. And you see this banks versus S&P divergence from 10-year treasuries, which is a bit unusual. And it's basically alluding to the idea that, you know, with mortgage rates ripping up to like 5% or above, you know, these banks are pricing in some future stress here, basically, right? And suggesting that we're seeing home sales rolling over in line with mortgage rates. So the housing market might have topped out. Looking at some of the results from the banks, you know, the loan books not really growing, credit card balances have come down. After those fiscal transfers made, you know, during the pandemic, people paid off a load of credit card debt and they haven't then gone out and, you know, raised it again. Loan defaults and credit expenses going up for the banks, potentially now that some of these moratoriums have expired and things like that. So, you know, these are the type of concerns. And if you look at when we had a previous divergence like this between kind of treasury yields and this relative performance of banks to the S&P, and that happened in 2018, the way that gap kind of closed was not with the banks rallying back, but it was like the banks were kind of pricing in things correctly and it was yields that rolled back over again. So the idea being that these 10-year treasury yields may now, you know, have gone a bit too far, and the way this gap kind of closes is with yields coming back down as yields start to reflect some of this potential stress and slowdown in the economy that's coming later this year, basically, right? So that's kind of what it seems like the bank stocks are basically pricing in. Yeah. Okay. Now the other big thing to talk about is China, right? So we'd mentioned a couple of weeks ago that this yen move that we were seeing could put some pressure on China, right? So you see this kind of China effective exchange rate and this Japan effective exchange rate, and they were massively diverging, right? And the idea being that, you know, that's going to basically make China less competitive and they're going to need to devalue, right? So we thought that might be coming. And so you've seen the dollar CNH has just moved dramatically, right, in the last sort of week or two, probably in the last week, right? So they have let it go. And this type of move is kind of similar to the type of thing we saw in 2015 in terms of magnitude. So that has partly led to some of the risk asset stress and some of the moves we're seeing in commodities and things like that. Now, they did cut the reserve requirement ratio by about 1% yesterday as this move was getting a bit rapid. So that did kind of, you know, revert it back a bit, but it remains to be seen if that's enough to kind of stop this move and they're going to let it devalue some more, right? So something to be aware of there, but that was something we had flagged and that seems to be what's happening. And then also, if you look at the implied vols in the CNH, which is typically, you know, a 2 or 3 vol type thing, because it's, you know, effectively pegged, that has doubled in the last week, right? That's gone from 3 to 6, which is a pretty dramatic move in implied vol, right? So the FX options market reflecting, you know, a lot more risk in that and the potential for this thing to continue moving. And if that happens, then that's going to provide some stress in risk assets, basically, right? If you look back at what happened in 2015, when this happened, it wasn't a pretty environment for risk assets, basically, right? S&P had some pretty dramatic moves to the downside, if I remember. Okay, so that's kind of what we're seeing in terms of the yuan devaluing side of things. Then if we look at the kind of supply disruptions that have been caused by these ridiculous lockdowns that China are doing, right? You've got various pieces of data around how many ships are waiting to load or discharge in the port of Shanghai, right? You look at this chart on the left, we see that it's kind of double the average, right? Or more than double the average. So, and then you've got this kind of graphic on the right-hand side, kind of just showing the congestion, right? So that is, and now they're talking about locking down Beijing potentially. Now, I don't think that's not as bad in terms of on the supply chain side of things, but that's more worse for sort of domestic demand and things like that. But this can't be good, right, in terms of supply chain. So at the moment, the commodity markets focus more on the demand destruction side of things. But what this means for supply chains and what this means for more persistent inflation and things like that, that we'll find out probably over the next few months, right? But it can't be good, basically, right? So that's one thing I would just kind of flag there, that there's two sides to this kind of China story. And whereas obviously the demand destruction side has not been great for commodities, just in terms of more persistent inflation for like the rest of the world, because of all the goods that we need to get out of China, and the delays that are going to get caused by these supply disruptions, then that's potentially going to be more persistent. Yeah. European equities had a little bit of outperformance. They're still down on an absolute basis, but with Macron winning the French elections over the weekend, and that's starting to get priced in late last week as well. We saw Europe starting to outperform as that tail risk kind of got taken out. But China's steady decline has been weighing on EM. You had a few other EM markets kind of weak as well, just kind of repricing a bit lower as some of those EM currencies moved on the dollar strength as well. So EM and tech the weakest, and then S&P and Europe slightly sort of outperforming there. If we look at the kind of vol setup and options market setup now, you can see obviously we're in short gamma territory again. So VIX term structure did briefly hit backwardation intraday. So you see there, it got to like 29-ish on the front. It was a little bit above 29. And then we started to see the vol selling come back, basically, right? We saw a load of put selling, hero indicator there on the right. You saw that spike up in the pink line driven by put selling early in the day. And as those dealers started to get filled and that kind of spike in vol started to mean revert and subside back down, that was when you got your delta hedging coming in through the Vanna effect, and that took the market higher, right? So you saw the S&P there trade up, after that put selling initially, then, that stabilizes, and then you saw the rally happen sort of, and after the European close, it kind of accelerated as well. And you also got the news about Twitter come out, Elon taking out Twitter, and that got the market a bit excited in general as well, right? So there's a combination of all those factors. If we look at the chart on the bottom, you can see, we're still firmly in that short gamma territory. So, expect markets to remain choppy, I would say here. And I don't think vol's going to absolutely collapse. There is some room for vol to come lower, but I don't think it's going to absolutely collapse until after the FOMC next Wednesday and the Fed do what they got to do. And that's similar to what happened in the March meeting as well, right? Vol held up, and then the meeting passed. They kind of did what was expected, and vols collapsed, and the market had a reasonable rally. So we may have a similar setup forming where you might get VIX persistent around the sort of mid-20s. And then once they deliver what they're going to deliver next week, and vol then has some room to reset a bit lower, provided we haven't had any more shockers in the market, then that might fuel a bit more rallying, basically, right? But I don't expect to see that happen in a big way before that. Okay. Looking back at 40 years of performance of this sort of global aggregate total return index, okay, and it's down 10% since the start of the year, which is double the worst performance of any year going back to 1980, basically, right? So this is an absolute shit show, right, in terms of bond market performance. So just sort of highlighting there that there's really been nowhere to hide. The 60-40 portfolio has been absolutely destroyed. Had the worst quarter it's ever had, and it's kind of like making people question, like, what is the right allocation? What are the diversifying assets that need to be in my portfolio? Things like that, right? So these are pretty big questions now after and it doesn't look like the dynamics that are driving this move are necessarily going to go away, right, in the next quarter. So people are seriously concerned, right? And you know, you look at the kind of inflation projections, right, through the inflation swaps. It's that drift higher in long-term inflation expectations that's really sort of helped that back end of the curve kind of the yields kind of spike back up again, right? So initially, when we were seeing more and more hawkish rhetoric 3 to 6 months ago, we were seeing curve flattening, right? As the front end was repricing rates, but the back end yields weren't moving because the market's like, yeah, we're going to get a slowdown. You know, in long-term inflation expectations are not unanchored, that sort of thing. But now we started to see post-Ukraine Russia longer-term inflation swaps moving higher, and that kind of leading to longer and nominal yields also backing up quite a lot, right? And we were starting to see a re-steepening in that part of the curve, and that is being driven by that, I would say. If we look at the kind of meeting probabilities that are being priced in now for the next few Fed meetings, you've got pretty much nailed on 50 bips for May. No surprise there. But what's interesting is we've got an 83% probability of 75 bips in June, which is monstrous, right? That's really your front loading that Powell was talking about last week. And then you've got another 80% of another 50 bips in July, right? So we're talking about a Fed funds rate by the end of July of over 2%, which is unbelievably different to where we were a few months ago, basically, right? So that's really what the markets kind of needs to wake up to. Now, a lot of equity players are saying never going to happen, right? And the Fed can't raise rates that much, but yeah, that's what the rates market's pricing in, right? And if you look historically, usually it's the rates market that tells the Fed what to do. They do what they're told by the market until something breaks, and then they have to reverse course, right? And until something breaks, you can translate that to until stocks are down 20% probably, right? It's kind of where we're probably looking. And even if we are down 20%, you know, depending on what the deal is on inflation, you know, we don't know where that strike is of the Fed put, right? We're assuming the strike of the Fed put is 20%, and we're suddenly going to see a repricing of rates back the other way if stocks are down 20%. But let's see what happens if we get there, basically. So you can see here commodities correction. So if we look at sort of the winners and losers over the last week or two, the standout losers have been uranium and silver. Obviously, uranium's like a retail favorite. It's a bit crowded. The fundamental narrative is very well known. Everyone likes it, but it's a long-term story, right? So that doesn't mean you can't get wild drawdowns in the short term. But if you like that story and you own uranium, you just got to make sure that you've sized it in a way that you can stay with the trade. If you get over levered on that trade, you get too big, it's a high vol underlying, and it could easily stop you out. The silver performance has been appalling, down, you know, I think it's around 8% or so. Obviously, China lockdowns, demand destruction, that was the main narrative behind this move in commodities. And also there was a bit of a need to flush out spec positioning, right? And which clearly, you know, when a sector's done that well, you know, there's going to be some spec positioning in there. And so it needs a bit of cleansing. And it seems like that's what we're going through at the moment, right? Now, whilst I like the fundamentals still, I have lightened up on my oil long. I had a bit of an oil long. I do think things could overshoot a bit to the downside if risk assets puke and you know what's happening in China and things like that. So I've kind of lightened up on oil. I have kept hold of my wheat and my uranium, and I've appropriately sized those in a way that I'll be able to stomach a drawdown. I won't need to puke those out if we get some weakness, basically, right? And for me, the fundamentals are still too compelling not to be long those ones, right? Whereas oil, I think, can swing around a bit more on terms of the demand side of things. So that's why I've lightened up there. But I would look to get long again, right? If we can retest sort of 80, 85 in a liquidation type move and a correlation 1 risk asset sell-off, then I'd probably be happy to dip my toes in around 80 again in oil, right? So that's kind of what I'm thinking about. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.